How interest rates influence real estate activity. Interest rates play a huge role in the real estate market. Whether rates rise or fall, they can affect home affordability, buyer demand, monthly mortgage payments, and even overall housing activity. For buyers, sellers, and investors, understanding how interest rates work is extremely important when making real estate decisions. In today's video, we'll break down how interest rates influence the housing market and why even small rate changes can have a major impact on buyers and sellers. Let's dive in. Interest rates affect mortgage costs. One of the biggest ways interest rates affect real estate is through mortgage costs. When interest rates increase, monthly mortgage payments usually become more expensive. That means buyers may qualify for smaller loan amounts and have less purchasing power. But when interest rates decrease, borrowing often becomes more affordable. Lower rates can reduce monthly payments and allow buyers to afford more expensive homes. Even a small difference in interest rates can significantly impact the total cost of a home over the life of a loan. Buyer demand changes with rates. Lower interest rates often encourage more people to buy homes. Why? Because lower borrowing costs improve affordability. As more buyers enter the market, competition may increase, leading to faster sales and rising home prices. On the other hand, higher interest rates may slow buyer activity. Some buyers may decide to delay purchasing, reduce their budget, or wait for better financing conditions. This can create a slower and more cautious housing market. Interest rates influence home prices. Interest rates and home prices are closely connected. When rates are low and buyer demand rises, home prices may increase because more people are competing for limited inventory. But when rates rise, affordability becomes more challenging. This may reduce competition and create more negotiation opportunities for buyers. However, local market conditions still matter. Some neighborhoods remain highly competitive even during periods of higher rates because of strong demand and limited housing supply. Sellers and investors are also affected. Interest rates don't only affect buyers. Sellers are impacted too. Some homeowners may hesitate to sell if they currently have very low mortgage rates and would need to finance a new home at a much higher rate. This can reduce housing inventory and keep supply tight. Real estate investors also watch interest rates closely because financing costs directly affect profitability and cash flow. Buyer confidence and market psychology. Interest rates also influence buyer psychology. When rates rise quickly, some buyers feel pressure to act fast before rates increase even more. Others may become nervous about affordability and pause their search completely. When rates stabilize or decline, confidence often improves and more buyers may re-enter the market. At the end of the day, interest rates are one of the most important factors shaping real estate activity. They influence affordability, monthly payments, buyer demand, home prices, and overall market momentum. But successful real estate decisions are not based on interest rates alone. Buyers should also consider their long-term goals, financial stability, lifestyle needs, and the local housing market. Because in real estate, understanding the bigger picture helps buyers and sellers make smarter and more confident decisions. Thanks for watching, and don't forget to like, subscribe, and share for more real estate tips and market insights.